Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Seth Cogswell. He is the portfolio manager and founder over at Running Oak Capital. We are talking about their ETF RUNN, the Running Oak Efficient Growth ETF. This is a long-running SMA strategy going back decades. Seth's father actually put the original ideas and pieces together. They have then been running this as SMAs and UMAs and now have jumped into the ETF business. They've had a ton of success already. The strategy is a mix of large cap as well as mid cap, 50 to 75 names in the portfolio. Really, really well thought out. So I think you'll find this episode really interesting, but I'll let Seth tell you all about it. So without further ado, please welcome Mr. Seth Cogswell. Hey, Seth, welcome to the show.
Thank you. Good to be here.
So before we get started, why don't we talk about, what inspired you to start Running Oak and a little bit about your background and how you got here?
It's been a long path, beginning before I was born. So a little different from probably the most similar managers. My father actually created our strategy in the 70s, again, before I was born. So pretty much out of the womb, I was surrounded by investment management. And so I grew up kind of hearing about what my father was doing. Pre-internet, they had these blue and orange stock chart books for the New York Stock Exchange and NASDAQ. And I would steal those and comb through them and imagine how easy it would have been to buy low and sell high. And got my dreams going. And at some point when I was in college and had a few $100s to my name, set up a brokerage account, did a lot of really dumb things, which luckily taught me with a pretty small amount of money that maybe I should actually learn what I'm doing. Read everything I could find, basically lived in the library. I'd run from math class to the computer lab and, day trade, which is maybe not the best, but did well, loved it. And then when I graduated, I became a trader in New York. That firm technically created a small hedge fund around what I was doing. So between trading and the fund, I did that for a while. And I always thought that was my dream job, partially because of the Market Wizards books. I don't know if you ever read those, but they always made it seem so amazing to kind of trade on your own. But at some point, I realized that I was basically just playing a high-stakes video game,
right,
for a very wealthy family. And at the best of times, I almost felt like I was stealing money from grandmothers. So it just wasn't very fulfilling. And so I opted to pivot. My father had been wanting to go off on his own for a while, but he's a very introverted individual. So the odds of him being able to really execute on that, raise money, was slim. And so I opted to go to business school to see if it made sense. Partnered up with the investment management professor there, put it through the ringer, and concluded that his strategy was actually far better than even he realized. And despite probably my better judgment and the advice of pretty much every single person I knew, I launched Running Oak with a whopping $800,000 under management. Some of my professors were my first clients, which is cool. But yeah, I mean, it was a circuitous path that led to where we are today.
Yeah, no, it's funny. You and I have similar backgrounds. I mean, my dad wasn't in the financial services industry, but I caught the bug early too. And I think I'm a little younger than you. I was able to at least day trade while I was in class. I didn't have to run from math class to the computer lab. I had it in my pocket at that point. But no, it's great. And before we kind of get into the nuts and bolts and the boring stuff of investing, it's I always like to know, what do you like to do hobbies, anything that keep you busy when you're not working?
Well, I have 3 kids, which means that I don't have a whole lot of spare time, and running a business is also not exactly the best way to have a whole lot of spare time either. I have some odd hobbies, I'd say. I don't know if this counts as a hobby, but I do spend a lot of time meditating. I try to spend 30 to 40 minutes every day uh, doing that, really just trying to be present. It's easy to get lost in the moment when you're chasing kids and running a business. And then otherwise, I've always been really into music. So in middle school, high school, I started out playing trumpet and then moved to tuba and was quite good, but I quit for very dumb reasons, despite loving it. And so when I graduated from college, I wanted to teach myself how to play saxophone, but I couldn't afford one. So I bought a clarinet for $200, taught myself how to play, played for a few years, and then just sort of, life got in the way. And then recently, over the last 2 years, my oldest kid started playing, and his music instructor also taught clarinet. And so she took me on. And so, any given Saturday morning, I'm probably online playing clarinet for 30 minutes. Maybe not the most macho of instruments, but the more I learn about it, actually, the more excited I am about it. And then actually recently I started taking lessons on the tenor sax too. So there's so many benefits to music, not to mention if done right, and I probably rarely do it right, but it has the ability to kind of speak to your soul. So it's a cool hobby that I get a lot of fulfillment out of.
No, that's great. I've tried to learn an instrument multiple times, whether it be the piano or the guitar. I just don't have the brain for it. So kudos to you. I'd love to be able to play an instrument, just I'm not built for it. But so let's get back to Running Oak. You guys run like an efficient, you call it efficient growth approach. And really, how has that evolved over time? And then can you kind of talk about some of the foundational principles that's really built this investment mantra that you guys hold?
I mean, really, the basis of the strategy is the fact that we don't feel that we are good at predicting the future. Some might be able to do it. We don't feel that we can. And so the strategy is really based on what we know versus what we don't know. So it's based on 3 very simple economic principles, which are maximize earnings growth, because nothing drives performance like earnings growth. When you buy a stock, you get a share of that company. If that company is growing, great, the value is going to grow. So maximize earnings growth. The second, though, is being very disciplined around valuations. Everybody talks about investing in undervalued companies, and certainly we seek to do the same. But the last thing you want to do is hold companies consistently or assets that should go down. And so, again, that goal is to maximize earnings growth to really kind of up that exponential growth for our clients. But then also nothing kills exponential growth like large drawdowns. And so that focus or that discipline on valuations, and then there's an extra focus on downside risk in general. One of the main ways we look to protect clients in that regard is debt. But that's my father actually settled on those simple principles by and large. It's changed a little bit, but in the 70s. And so it really hasn't changed much. We are effectively doing what he created and has been running for almost 4 decades. One of the reasons why it hasn't changed much is because it didn't need to. And that's because the simplicity and kind of common sense nature of the investment strategy. And so that sort of simplicity has led to it being very robust and standing the test of time. So it really hasn't changed or evolved much. When I took it over, I have a lot of confidence in my intelligence, whether it's well-founded or not. We can debate, but I'm very good at making something better. But on this, I've had to hold myself back. From the very beginning, my goal was to just let it be because it did so well for so long. I had my chance to create something that was better, and I didn't. So it really, what we do right now is almost identical to what we've been doing for 4 decades.
Yeah, and you also do this not only in the ETF, which we're going to talk about, but you also offer UMA models, SMA. And so is it so how did you guys decide to kind of go from traditional SMA, UMA type to deciding, hey, I want to get in the ETF business?
Sorry, you froze up for a second. I didn't get the entirety of that question.
That's okay, Seth. No, I was just saying you guys run a variety of different things: SMAs, UMAs, ETFs. I the ETF. How did you guys decide really to go from that structure and then move into and get into the ETFs? Like what corporate decision went into saying, okay, look, I want to make this thing public. We're going to go out and get into the ETF market.
Launching an ETF has always been on the table, or it was one of the options even when I started running Oak over 12 years ago. And it was one of the things that I considered. The ETF market's changed dramatically since then. Before, it was probably more a matter of licensing it to a big company and getting 5 basis points or something. And so the world has changed. But again, when I started the company, I started out with my own savings account, and with a whopping $800,000 again. So I had to be very mindful of the sustainability of the company. I had watched the strategy perform very well over decades, and I thought that the only way it wouldn't be very successful was if I ran out of money and I wasn't able to pursue it indefinitely. And so separate accounts made the most sense initially, just because you can run them very efficiently. And there were a number of benefits. The ETF just wasn't a great option at that time. It just didn't seem like it. We opted to launch the ETF 2 years ago when a firm that I've known for 7 years, I had actually cold called them quite a while ago, and spent tons of time with them, grabbing lunch, grabbing drinks, and then out of nowhere they're like, you know what, we're not going to invest in SMAs. I was like, well, why didn't you tell me that 7 years ago? And then they're like, but if you had an ETF, we'd invest, a significant amount of money. And I was like, well, why didn't you tell me that 7 years ago?
Right.
And so it was really, ETF was always on the table. It was really just waiting for the right time. And the right time presented itself. I have a lot of made up statistics I like to throw around, but one of them is I have a feeling that roughly 80% of managers that launch ETFs regret it, just because they're very expensive to manage and they're very difficult to grow. And so that was always at the top of my mind. Again, it's my company, right? It's my savings account basically, and I have 3 children and a wife depending on me. So I had to be very mindful of taking on that risk and launching it at the right time, and the perfect time presented itself. And so we launched it 2 years ago.
That's great. So let's talk about the Running Oak Efficient Growth ETF, ticker RUNN. So for listeners that are new to Run, how does the ETF work at a very high level? And then there's about 50 to 70 stocks in that portfolio. You talked a little bit about that efficient growth process, but maybe dive a little bit deeper on the process from getting to a giant universe to 50 to 70 names.
Yeah. So one of the things that really separates Run, or if you're a Caddyshack fan, Run. What really separates it from many of our peers is actively managed ETFs are fairly new. Our strategy, on the other hand, has a 5-decade history, right? Our SMA has a 12-year audited history, and the ETF is the exact same holdings, the exact same strategy and process. So there's really nothing new about the ETF other than the structure itself. That's it. As far as how we end up with the portfolio, we begin with companies that are above $5 billion, trade on U.S. exchanges. When you constrain your universe, you constrain your potential. And so the first thing is to be just very thoughtful of where you're going to apply those constraints. And we constrain our portfolio at $5 billion and below because it's hard to argue that you don't take on more risk as you invest in smaller companies, whether they're less liquid whether they're just simply less proven. But we're open to anything above $5 billion. So that is our starting point. Our goal is to maintain a portfolio consistently that has significantly higher earnings growth than the S&P, because again, nothing drives performance like earnings growth. Historically, the portfolio has averaged around 12 to 13% earnings growth versus the S&P, which is around 6 to 7. The S&P's earnings can be wildly volatile, but over the long run, they average around 6 to 7. There's reason to think that maybe even that begins to decline a little bit. But regardless, that's about a 6 to 7% gap on average that we maintain that we would expect to drive performance. In order to reach that 12 to 13% average earnings growth, we have to have a cutoff that's below it. So generally it's 10%. Anything that we don't expect to perform at that level going forward, we eliminate. We then run our valuation model on everything that made that first cut. The valuation is the way in which we value companies is certainly one of the biggest differentiators. I haven't seen other people doing it the way that we do it. Many do either discounted cash flow models where you're sort of trying to kind of predict the future and discount it back. And for us, we don't feel that that's something that we really, that we do best. Many will look within a sector and invest in the cheapest price to book or PE. We don't do that either. Instead, what we do is we really measure the wealth creation of a company over an extended period of time, compare that to the S&P 500, and then create a relative comparison for the price too. It's a lot more complicated than that, but just to give like a little bit of an overview, it's a relative valuation, which I really haven't seen other people doing. Anything that's deemed to be overvalued, we cut. We don't want to invest in companies that should go down. And then at that point, we look at a number of simple metrics that we believe very clearly lead to greater downside risk. The most important of which, especially over the next decade, is debt. As individuals, we know if we take on too much debt, it's not going to work out well. And that's the same for small businesses and large corporations. And so we invest away from companies with high debt levels. And we look at some other smaller things. We then score each company that made it to this point based on those different qualities or characteristics. Obviously, higher earnings growth is preferred, more attractive valuation, lower debt levels. And then we force rank the list and invest from the most attractive to the least. As we do, there's a few considerations that we have in mind. We know we want 50 to 75 companies. Right now we hold 54. Usually that number starts to decline as we get later in bull markets. On average, it's probably in the 60s. And then we look at industries, which is a little more granular than sectors. Value Line breaks the market up into 99 different industries. And we want to make sure that we're diversified in that way as well. And so our goal is to maintain a portfolio that has a minimum of 30 industries. Usually it's in the low to mid 30s. We have a hard cutoff of 25, and then we'll cap any one industry at 15%. So the end result is you get this portfolio that is very risk focused as far as the stock selection, right? They have to be attractively valued per our numbers, and they have to be lower risk in a number of ways. And then we build the portfolio with risk in mind as well. So it's diversified across names. There's a larger number of names, again, 50 to 75. It's equally weighted. And then it's also diversified across industries with the goal to really reduce idiosyncratic risk. So that one company doesn't really matter. The goal is to just consistently maintain those qualities that we feel are highly likely to provide higher return and lower risk over the long run, which again are higher earnings growth, attractive valuations, lower downside risk.
Yeah, no, I love the portfolio construction process. I agree with a lot of things you just said there. What if you're going through, I caught this, you're kind of going through and scoring these companies and arriving at your list. However, the portfolio is, you are equally weighting. So why do you prefer that equally weighting approach rather than maybe a score weight approach by weighting heavier, maybe some of your better scoring names? But can you just talk about why you kind of decided that equal weight is superior?
So most simply, if we compare equal weighting to cap weighting, equal weighting up until the last decade had outperformed their cap weighted counterparts over every single rolling decade in history, except for very recently.
Yeah, Seth, somebody who runs an equally weighted S&P sector strategy, believe me, the last handful of years have hurt pretty bad.
Yeah, not fun. The reason why equal weighting outperforms cap weighting over the long run is because it takes advantage of mean reversion. Cap weighting is basically a momentum play. Luckily, we haven't seen a bear market, we could argue, in 16 years, which has really favored cap weighting as people just pile into the same things, driving that wave larger and larger. But over the long run, stocks can be noisy, right? You've got people buying and selling based on different reasons, emotions. And so equal weighting takes advantage of that noise. Now, for us, as far as equal weighting versus alternative weightings, that's something that I've thought about a lot. And that really touches on an important philosophical point of our strategy, which is many managers have maybe not but lean toward more concentrated approaches, because that's a way to differentiate yourself from the indexes, potentially provide outsized returns. And if you're taking a concentrated approach, maybe you do a very deep fundamental dive on a company and you decide this is a great investment. You do that for some other companies, and now you've got a portfolio of high conviction names. We have a totally different approach. We have, particularly me, I have absolute conviction that if we maintain a portfolio with higher earnings growth, attractive valuations, lower downside risk, that we will, over the long run, provide higher return, lower risk. Nobody will ever be able to convince me otherwise. Now, we don't necessarily have that level of conviction for the individual companies, though, right? We're not talking to management. For us, we don't feel that's where we have an edge. And so we look at each company, as long as it meets our criteria, as a coin flip. Basically, if you think about flipping a penny, you could flip a penny 10 times and get 10 tails in a row. It's unlikely, but it could happen. The more you flip it, though, the more likely it approaches 50%, right? So 50% head, 50% tails. And we look at each company as a coin flip. Each company gives us an opportunity to deliver those qualities that we aim to provide our clients.
Yeah, no, it makes a ton of sense. And, the whole process, as we've talked about, is a completely rules-based approach, but it is actively managed. So, where do you think the team adds the most value? And can you also talk to me about how often you are rerunning the process to either select new names, add, remove, reweight? Could you talk about that a little bit as well?
So the difference between passive and active, or the definition, I feel like is ever changing. I don't even know if I know the whatever definition people want to apply these days, but we are defined as active because we use thought. That's basically it, right? You're either thinking or you put on autopilot. And you put on autopilot in a way that the S&P or whoever owns the passive world agrees that that's okay. So our strategy is very common sense and thoughtful as far as how it's constructed, but it's actually very passive-like as far as the rules-based nature of it. You could easily argue that our strategy is index-like. Now, it's not a black box. There is a little bit of complexity there, but it's largely defined as active because it's thoughtful and it's not just run-of-the-mill. Now, as far as the role that we play otherwise in an active manner, the purpose of the rules-based nature is really to remove us from it. It's well documented that a well thought out process will outperform a thoughtful individual most of the time, just because as people, we are inherently emotional. We have opinions. I certainly don't lack for opinions. And the goal of the rules-based nature is to really remove those opinions, remove those emotions, so that we are very consistently providing precisely what we tell clients we'll provide. And so, again, the goal is to not be especially active. There's very rare moments where we step in, and those are kind of one-offs. And largely just if the world has changed, but the data doesn't yet reflect it, maybe we'll step in, right? So if there's a SEC investigation or something, we'll step in. But otherwise, we really try to adhere to the rules with as much discipline as possible. That's their job and purpose.
So can you just talk real quickly, though, about how often are you going to rerun that process? How often does the index, we'll call it your index, like, how often is that changing, rerunning quarterly, monthly, weekly, daily? How often are you making decisions?
So the data that we utilize is somewhat slow moving. We're largely using quarterly data. And so, yes, the price is moving a little bit day to day, but we hold the average company 4 to 5 years. So it'd be there's no reason to be running it day to day. That would be pretty fruitless. And so we reconstitute the portfolio where we make additions and deletions 3 times a year. We do that at the end of April, early May, because that enables us to take into account the full prior year worth of data. We do it late November, early December. That gives us the opportunity to kind of build the best portfolio heading into year end, as well as certainly on the SMA side, realize gains if it makes sense. Well, realize losses before year end if it makes sense, and then kick gains just a few weeks out so that we can push that off. And then we split the difference in August. And then we'll rebalance the portfolio because, again, it's intended to be equally weighted. We usually rebalance the portfolio at that time. And then we'll also rebalance as needed depending on what's going on within the market.
That's great. So, you guys have had a lot of success out of the gate. I mean, you launched with just a few $1 million in assets and you've quickly scaled beyond 350 million. What do you think really drove that early momentum? I know you had mentioned you had somebody who was already interested, but that's significant growth in a fairly short period of time.
The answer is hard work. Maybe a little bit of luck in that, again, I didn't create the strategy, so I inherited it. But it's been very hard. We launched with 2 million. We're up to 370 now. Not that I'm counting, in 2 years. But again, a lot of that was driven by relationships that I had built for years leading up to it. I mean, I did not launch the ETF until we had at least 50 million committed that I thought was dependable. And then it also helped that at the time of launch, we were in the top 1 percentile of mid-cap core managers. So that certainly helped. That's a nice little soundbite to get people's attention. And then again, hard work. I think a lot of people launch ETFs with a little bit of a field of dreams mentality where if you build it, they will come. And it's just not true. It's very, very hard to grow. And I have never worked harder in my life than the 6 months leading up to the launch and then after it. I mean, there were times, hopefully this isn't overshare, but there were times where my wife couldn't find me and I was laying in bed in tears because I was just not sad, but just so exhausted from just pushing so hard. And at the time it made sense and it was very fulfilling, but it is not easy.
No.
Going from 2 to 370 million, there was some luck that helped, but it was, again, a lot of hard work.
Well, no, it's a great story. And I think too, you're actually coming into a time, as you said, you think mid caps could be an attractive space right now. I mean, we've seen so much go on in large cap growth. Everybody's chasing and been chasing the Mag 7, but you have some mid cap exposure here. So how is RUNN positioned to take advantage of that? And is mid caps hopefully about to have their time over large caps like we've seen over the last 36 months?
We might have to do another podcast just to fit all this, whatever I could say on mid caps in. But there's 4 words that I'd say are the reason for many to rethink their approach to investing and consider mid cap or just a slightly unconventional approach. And those 4 words are higher return, lower risk. Mid cap stocks over the last 33 years have outperformed large cap by, last I checked, 60 basis points annualized. That adds up to over a 20% return, I believe, over that period, right? So very meaningful. And mid cap absolutely smoked small cap over that same period. Keep in mind, mid outperformed large despite large and mid cap destroying everything for the last decade, and mid still outperformed by 60 basis points. And why? So first of all, you've got that data, right? You also have the philosophy or the rationale backing that up, which is mid cap stocks they've kind of graduated from small cap. They must have had some product that was successful to get to that point. And so therefore we'd expect them to be less risky than small. Large, the bigger you get, the harder it is to grow, generally speaking. Now there's a network effect at times for some companies, but if you think of Apple, it's such a large, massive company. It's really hard to see how they can double. Whereas a mid-cap company, if they got there based on one product, now they only need one more product to potentially double. And so mid-cap is the sweet spot of asymmetric return and risk, which is what we should all be seeking. So again, higher return, lower risk. Again, there's a number of different ways I could really run with this because I love talking about this, but there's a few very important considerations as far as this goes. One is the idea of, actually, let me back up for a second. As I've spoken with more and more large firms and gotten a better view of how most people are building portfolios, it's become really obvious why, one, how few people actually have mid-cap, and two, why they should. One is most people build portfolios in a similar manner. Many of the biggest firms, they start out with large cap growth because if you didn't have large cap growth over the last decade, you got fired. So you start out with that. And then you complement it with most use SMID, so small and mid. It's sort of a one-stop shop to just sort of add some diversification and then value. And the problem is many don't realize we invest in these large cap portfolios thinking they're diversified when they're not. And I would be guilty of the same. Many don't look under the hood. So if you look at SCHG is one that I use a lot just because I see it regularly. Very recently, SCHG had 60% of the portfolio invested in only 8 companies. Those 8 companies are very highly correlated. They're all mega cap. And so you're getting 60% of your portfolios in this tiny sliver. And the problem is people invest in it thinking they're getting this diversification when they're not. And then if you think about investing in SMID, that's centered around that small midline. And so you get very little upper mid cap. And so there's this huge gap in most people's portfolio in a place where we would never expect there to be absolutely nothing invested, right? So we're talking upper mid, lower large cap is a woefully underinvested area. And we're not talking microcap, we're talking big companies. Right. And again, why that really matters and why people should seriously consider it is a very simple concept that I never hear anybody talk about, and that's investing where other people aren't. If you're investing where other people are, and so over the last decade, you could argue that the big tech names, the S&P 500 is maybe the most overcrowded trade in history. And so if you're investing in those companies, you're investing after everybody else or with everybody else. And just by supply and demand, that means that you're paying higher prices. If you pay higher prices, you get higher valuations, which implies lower potential returns and higher downside. So lower return, higher risk. Not what we generally would say we're going for. Whereas if you invest where others aren't, you get lower prices because the demand's not there driving it up, which implies lower valuations, which implies higher potential return and a margin of error, lower downside risk. So that's where you get that asymmetry. You take less risk to get higher return. That is why I would say maybe not just mid-cap, but just really rethinking how people are investing, or at least kind of diversifying, right? It's an uncertain world. It's a good time to really be hedging your bets a bit and make sure that you're, not setting yourself up to, for things to turn.
Yeah. So with that being said, and some mid-cap tilt here, as you're talking to advisors, they already have a diversified portfolio of ETFs as well as other things. Where are you recommending RUNN goes? Is it in that mid-cap tier, or do you think it belongs more as a core equity holding?
Historically, our strategy has generally had about 50% invested in mid, 50% invested in large. I mean, it's an important note to say, first of all, that line between mid and large is made up, right? There's multiple firms that can't even agree on what that line is. It's a made up line. So yes, we say mid cap, but it's a general area. Same with lower large cap. And that's really where we fit and where I generally recommend using us is as that sort of truly core holding, because it, again, walks the line between mid and large cap. But also it's growthy. We want to maximize growth, but that discipline around valuations and debt and risk brings it back into core. And so you get this diversified portfolio, very risk focused, that fits just in the center of your portfolio. And then it makes it really easy to complement with more innovative growth, right? So think of, whether it's NVIDIA, Palantir, things that aren't yet, that for a while weren't profitable or the valuations got ahead of themselves. We won't invest in those because it just doesn't meet our rules. That's a great complement. And then you can complement on the value side as well as small cap. But again, it's really meant to be that very dependable core holding. And the rules-based nature means that what we're doing at all times. We've been doing it for 4 decades, right? So ideally, it's kind of that very consistent, steady sort of foundational holding in the middle of your portfolio.
Yeah, no, I love it. And Seth, I really appreciate your time with me here today. It's super thoughtful discussion. I think the strategy is great. And you've made, you're right. You and I probably could have talked about the differences between why mid caps are an attractive space for probably another 35 to 45 minutes. But before I let you go, though, where can people learn more about Running Oak? Where can they learn more about the ETF?
One, you can definitely check out runningoak.com or runningoaketfs.com. I have very begrudgingly become far more active on social. So LinkedIn it could be a really good resource. I've been a lot more active as far as posting both our letters as well as short videos that are a little more poignant and go into different topics. Those are probably your best resources.
Great. Well, again, Seth, thanks so much for spending some time with me.
Thank you.